Hi, I'm Kathy Dice and welcome to the BudgetEase broadcast. Today we're going to talk about why you should love the budgeting process. The word budget often has a negative connotation to it. What does it mean to you? Does it bring visions of restricted spending, maybe deprivation, maybe long hours to try to figure things out? Well, we all have great ideas for our business that are going to make it a success. How do you know if the plans you see in your mind are going to work? Well, a budget is a great tool to help foresee the results of your plans prior to executing it. I prepare a budget for all my clients. A budget is that important. After this session, you'll be able to build a budget to test your assumptions about your business plans too. To start, a budget by writing down all your assumptions, like I expect to continue to grow by 3% this next year. I will be giving myself and my staff a 3% raise. I will be using a project management system that will cost me $10,000, but I will be able to reduce staff by one person. You see what I mean? Next, make a template using your prior financial information. Pull a monthly profit and loss statement in QuickBooks and export it to Excel. Then add 2 columns, one for notes and one for the total of the period of the budget, which is the next 12 months. Now you have your template. And I've included a link to a template that you can use below to fill out your budget. Look at 3 things: sales, profit margin, and total expenses. First, review your historical revenue. What are your existing sales and what is the growth rate that you are experiencing? Is that revenue seasonal? Is it steady? Next, determine your growth rate for the next year. Say you are aiming to grow 10% over the same month last year. You would simply multiply your growth rate by your percentage anticipated growth of 10% a month and do that through the entire year. That would be your sales by month for the upcoming year. Use the sum function in Excel to determine your total sales for the period. Second, look at the direct costs or the cost of goods sold for the prior year as a percentage of your sales. This is your gross profit margin. Add a line in this spreadsheet to calculate your gross profit margin to easily see what it was last year. Your gross profit margin is your direct costs divided by your total revenue. So, for example, if it was a 40% gross margin in the last year, you would use that percentage as a percentage of your new revenue amount for the budget. You may find, though, that at the very end that you need to improve your gross profit margin to maybe 47% by eliminating some unprofitable services. You can now allocate the cost of goods sold by month to achieve a 47% gross profit margin. Finally, determine if there are any new expenses you expect to incur to achieve your goals. Will you add an employee, update a website, buy a vehicle? In your budget that's in Excel or directly into QuickBooks, enter expenses by month and by filling the base amount for the remaining sales for the year. When done, look at your total expenses each month. Expenses should be about 30% of sales or less. Go back and look for opportunities to reduce expenses, perhaps by hiring a part-time employee instead of a full-time employee, reducing some of your subscriptions that you're not fully using, or talking to your landlord about reducing your rent. Once you draft a budget, determine your expected profit. Does it meet your needs? If not, go back and make changes until you have the desired result. With a budget, you can test your decisions on the business before the damage is done. Drafting a budget and entering it into QuickBooks is easy using these steps. What can you do right now to start your budget? Your future self will thank you. Hey, thank you for joining this broadcast, and we look forward to seeing you at the next one. Goodbye.